What you're looking at is not a broken housing market, it's a misaligned one. For the past few years, we've been operating with outdated assumptions, applying yesterday's playbook to a completely different environment. This presentation is about resetting that thinking. It's about understanding what's actually happening beneath the surface and, more importantly, how to adapt. Because in 2026, success doesn't come from waiting for the market to improve. It comes from using the right mechanics to move within it. I am Steve Colino, and this is Confidential Remarks. The key insight here is simple but critical. The market hasn't collapsed, it has frozen. As shown on this chart, only 4.7% of homeowners sold between 2023 and 2025, marking the lowest turnover in over 4 decades. That's not a demand problem. That's a movement problem. At the same time, homes are sitting longer, with average days on market climbing into the 60-plus range and pending sales down double digits year over year. What we're dealing with is friction, systemic friction, that's slowing everything down. To operate effectively today, you have to let go of 2021. That market no longer exists. Back then, homes sold in under 20 days. Rates were below 3%. And sellers routinely received 5 to 10 offers, often with waived inspections. Fast forward to today, and we're in a completely different environment. Homes are taking over 60 days to sell. Rates are above 6%. Offers are limited, and buyers are cautious and negotiating hard. If you price and position based on nostalgia, you will miss the market entirely. This is the engine behind the freeze, the mortgage lock-in effect. 73% of homeowners say they would move if they could keep their current rate, but they can't. So they stay put. That reduces inventory, which keeps prices artificially high. High prices combined with higher interest rates push buyers out. Listings sit. Sellers get frustrated and pull homes off the market, and the cycle repeats. This isn't a temporary slowdown. It's a self-reinforcing loop that removes over 1 million transactions from the system. Here's where the breakdown becomes visible. Sellers are still anchored to peak 2022 pricing, while buyers are anchored to what they can actually afford in today's rate environment. That gap creates what we call the delisted zone. As shown here, 32% of new listings were pulled from the market in early 2026, up dramatically from just a few years ago. These aren't bad homes. They're mispriced homes. When expectations and affordability don't align, the transaction simply doesn't happen. This is where strategy replaces frustration. Instead of treating commission as a fixed cost, we reframe it as deployable capital. Traditionally, a 5.5% commission disappears into the transaction with no direct impact on demand. But by reducing that to 3.5%, we free up roughly 2% of the home's value. That's not a loss, it's leverage. That capital can be redirected to directly influence the buyer's affordability without reducing the seller's net outcome. Same profit, completely different result. Once you reallocate that capital, you change the speed of the sale. The traditional model, full commission, no adjustment, results in homes sitting for over 60 days. If you apply that savings as a price reduction, you accelerate the timeline to around 40 days. But if you apply it strategically, specifically into financing, you can compress that timeline even further, down to roughly 30 days. This is not theory, it's math. When you reduce friction for the buyer, velocity increases. Not all strategies are created equal. A price drop might make a listing look slightly more attractive, but it barely moves the needle on monthly affordability. In this example, a price reduction saves the buyer about $73 a month. Now compare that to a structured rate buydown. That same capital can reduce the buyer's payment by nearly $500 per month in the first year. That's the difference between this is a better deal and I can actually afford this home. One is cosmetic. The other is transformational. The 2-1 buydown is the most effective tool in this environment. It temporarily reduces the buyer's interest rate, typically by 2% in year 1 and 1% in year 2, before returning to the full rate. That gives buyers immediate relief on their monthly payment and creates a clear path to refinance later. What you're doing is bridging the gap between today's rates and tomorrow's expectations. It allows buyers to qualify, act, and compete right now. At this point, the choice becomes clear. One path is what we call the post and pray approach. List at a high price, pay full commission, and hope the market responds. In most cases, it doesn't. Homes sit, price reductions follow, and the seller ultimately loses control. The alternative is the value leader approach. This seller aligns pricing with reality, reallocates commission strategically, and invests in buyer affordability. The result is faster offers, stronger positioning, and a controlled outcome. Execution matters just as much as strategy. The MLS description becomes a signaling tool. It tells agents and their buyers that this home is priced for today's market, not yesterday's. It highlights the commission structure, the financing strategy, and the seller's readiness to transact. This does two things. First, it builds trust by showing transparency. Second, it creates urgency by making it clear this is not a listing that will chase the market down. It's positioned to move. Here's the bottom line. The market is already starting to thaw. Affordability is improving, rates are stabilizing, and transaction volume is projected to rise. But not for everyone. It will favor those who adapt. You don't need perfect conditions. You need the right approach. Price aggressively. Offer financing solutions. And reallocate commissions with intent. When you do that, you don't wait for the market. You move within it and you win. This has been Confidential Remarks.